Welcome to our first quarter webinar. I'm Joe Zidle, Chief Investment Strategist, and I'm thrilled as always to be joined by Byron Wien, Vice Chairman. Thank you, Byron.
Always great to be with you, Joe.
This first webinar of the year is always my favorite because we get to discuss the 10 surprises. As many of you have probably already seen, last Wednesday, January 4th, Byron and I released the 38th annual edition of the 10 surprises. Amazing. Byron, I've been reading your surprises my entire career beginning in the mid-1990s. And since joining Blackstone 5 years ago, it's been an honor to co-author these with you. Before we get into the webinar today, I want to share with our audience some perspective on what goes into the production of the 10 surprises each year. The process starts in the summer on Eastern Long Island with the lunches you've been organizing for the past several decades. This year, you hosted 3 lunches and a Zoom with 25 to 30 participants at each one. The group includes leaders in the finance and real estate worlds, as well as some academics and policy experts. From there, we spend the fall right up to the December break debating what the team thinks is likely, what's already in consensus, and what isn't across a range of asset classes and outcomes. And Byron, you continue to set a standard that brings out the best in all of us on the team. I remember the first year that I worked on the 10 surprises with you, you were asking me about my plans for December break. I told you I was taking my family on vacation, and you said, Joe, in my nearly 4 decades of writing the 10 surprises, I've never taken a Christmas vacation. And then I reminded you of one of your life lessons, which is when you get a new job, make it your own. So before we get into the 10 surprises of 2023, let's quickly review the surprises from last year. Byron, take it away.
Okay, well, the first thing we've got to do is define a surprise. A surprise to us is something we believe has a 50% chance of happening, or better than 50%, where the average professional investor would give it a 1 out of 3 chance. So you'll find a theme throughout many of these surprises where we got the direction right, but we didn't go far enough. In the first surprise, we said that strong earnings would clash with rising interest rates, and the S&P 500 would make no progress in 2022. Value would outperform growth. We were right about that. High volatility would continue, but the market wouldn't go down 20%. Actually, the market went down 25%, so we were right to be cautious, but it ended the year down 20%.
And you're right about not necessarily going far enough. I think that's something that we're going to see in a number of these surprises, but this one in particular, Byron, and we came into the year thinking that the economy would be relatively strong, but we were clearly more defensive about the markets because of rising interest rates. Earnings growth ended up being relatively decent in 2022. I think S&P profits grew to maybe around $220 a share or so. We'll know that once fourth quarter earnings are announced. And the point on value outperforming growth. For the year, I think the S&P 500 value index was down maybe around 5%. The growth index was down almost 30%. So directionally, we were right, but it was just a case of not going far enough.
Right. And that's true in the second surprise, too. We said commodities would decline, but wages and rents would stay high. We said the consumer price index would increase 4.5. We were wrong by 50%. It was up 9% in July. And we thought that transportation, energy would decline in price. But the diehard view that inflation is transitory, that one is put in the back burner. Persistent inflation was the dominant theme.
This was probably one of our most out of consensus views going into 2022, because at the time, the dominant narrative out there was transitory. And you can see that across a range of forecasts from economists. And I think one of the things that we were very consistent on, not only in 2022, but even backing up a little bit into the mid part of 2021, was the idea that this inflation would be more persistent. And I think that really reflects the data that we are able to collect here at Blackstone from our holdings across private equity, real estate, and credit, and looking into that data, it really gave our team the conviction that these inflationary pressures would be much more persistent.
One thing I'm wondering about, Joe, is if inflation comes down to 2 or 3% by the end of 23, I wonder if Jay Powell will say, you see, I was right. It was really transitory.
We'll see. The odds of inflation coming down to the Fed's target, in my opinion, are still pretty low. The easy to solve stuff is being worked out right now. We see that. But there's still the wage pressure out there. And, wages end up being, or income ends up being, really foundational to the inflation story. So the easy to solve stuff, yeah, I think that gives voice to the doves. And I think it gives voice to many people out there that say, see, it is just purely transitory, but there's still a lot of wage pressure out there. You see that across average hourly earnings. The employee cost index continues to run in the high 5.5% range. So I think it's going to take there's some wood to chop there.
Great. So looking at the third one, here we are again. We said that interest rates would go up. The 10-year Treasury would rise to 275. We were off by a full percentage point there, and it's going, it's going over 4, probably to 5. The Fed completes its tapering and raises rates 4 times. And I don't know how many times they did, but they're getting at 4.5 to 5 now. So we were right that rates were going up, but we were wrong. They went up a lot more than we thought they would.
I kind of viewed this one as us planting a flag in the ground, thinking that inflation was more of a problem and that it would be more persistent, and it would push the long end of the curve up as well as drive the Fed to hike. And the reason why I say planting a flag in the ground is because at the time the consensus was that the Fed would stay accommodative for a long time to come. I think we started the year with the 10-year Treasury yield at 1.6%. And as best I can remember, looking across major forecasters, I think the high estimate on the street was around 2.25% for the 10-year. So this was really about planting a flag in the ground. But to your point, Byron, again, it was just another example of how we didn't go far enough in a lot of these.
In the fourth surprise, we said we'd get sort of back to normal. People would go to events. There would be conventions once again. And that would be true of offices too. People are in the office 3 or 4 days a week. I think that's improved, but we haven't really gone back to full normal.
Certainly not to the office, but one of the key points I want to make here, a key phrase is, en masse, that people would return to theaters, concerts, and sports arenas en masse. And you see that with the TSA transportation checkpoint data, where basically flights are, back to 2019 levels. And when you think about concerts, well, all I can say is Taylor Swift's Era Tour to support her Midnight album. I think estimates say that based on the demand, she'd have to play something like 900 stadium tours in order to fulfill that demand. I only know that because my kids, well, they're Team Swift.
Okay. In China, we were right that China would try to crack down on speculation in its property market. That's the way the Chinese store wealth. They don't buy stocks or bonds, they buy property. And it got way out of hand, and China tried to do something about it. We thought that they would try to encourage a domestic money management industry, but that didn't happen. One of the things we totally missed in China was the universal lockdown, which paralyzed the economy. That was the most important development in China. And as a result of that, China is going to grow at 3% or less in 2022.
Yeah, and the idea here is that households in China generally have about 70% of their net worth tied up in housing. And so it was about a pivot toward investment. And I guess maybe it's a longer term trend that we'll see how this plays out over time. And I guess maybe what we got wrong here was that they would pivot so quickly in 1 year, when I think it is something that will end up taking years and years and years. In the sixth surprise, we thought that gold would rally 20% to a record high. And we also thought it would reclaim its title as a safe haven asset from cryptocurrencies. In the beginning of the year, this was really moving in our direction. By March, gold prices were up 13% year to date, but it traded roughly flat for the full year. And I think if you look at sort of a series of asset class returns, one of these return quilts, what I think is interesting to point out is that the number one performing asset in 2022 was commodities, up about 23%. Gold was the second best performing asset, and it was approximately flat for the year. So again, I think directionally we got it right.
This is one where we may be a year early. 2023 may be gold's year. We have a habit of not putting a surprise in 2 years in a row, so gold is not in the 2023 list, but the prospects for gold in 2023 are pretty good. So we may get what we thought was going to happen in 2022. That may happen in 2023.
And the seventh surprise from last year, we thought oil prices would move higher, and we thought that the price of West Texas crude would trade above $100 a barrel. Now, we did not anticipate war in Ukraine, but when you look at the effects of war in Ukraine on oil prices, you saw that oil spiked at the beginning of the year. And West Texas WTI crossed above 120 in March, and then again in June. For the full year, oil prices were roughly flat, but nevertheless, directionally, this is one where I would say we get partial credit. What do you think, Byron?
I think we definitely get credit for we're right for the wrong reasons here. That's the most you can say about it.
Which sometimes happens with the surprises.
Yeah.
And that's about the time when we tell people that we don't do these for the score, but rather to stretch our thinking. In the eighth surprise, we wanted to highlight nuclear as an alternative for power generation. We thought that there'd be enough safety measures developed to reduce the fears of its danger, and that the viability of nuclear power would be widely acknowledged. When we think about the evolution of nuclear in 2022, there are probably two things that I would highlight. First is that the Nuclear Regulatory Commission did approve a new design for a modular nuclear reactor, basically a mini nuclear reactor. We thought there would be the approval of a development site somewhere in the Midwest or something like that, but you actually did see some movement on these modular, smaller nuclear generation devices. And then secondly, fusion technology. And this is the last line of the surprise. We thought fusion technology would emerge as a possible future source of energy. And this is one that we basically almost had given up on until like December 13th, when you saw that announcement from on nuclear fusion, which, while it might be still way off in the distant future, we did sort of hedge our view a little bit here when we said a possible future source of energy. So that one came all the way down to the wire.
My view is that we're not going to solve the power generation problem without using nuclear. That if we don't adopt it soon, we'll adopt it sometime. You already see Germany loosening its restrictions on nuclear energy. France continued to derive 70% of its electricity from nuclear energy. So nuclear is still out there, and we think it'll be embraced more as time goes on.
Yeah, and fusion does give us something to look forward to. Personally, one of my favorite movies growing up was 1997's The Saint with Val Kilmer and Elizabeth Shue, and that was about the pursuit for cold fusion. So a little bit ahead of its time. In the ninth surprise, we thought that ESG would evolve beyond policy statements. So at least directionally, there was some movement. And again, with some of these surprises, we just might have been a little bit early on this.
Well, ESG funds underperformed the S&P 500. for 2022. So that gave rise to some of the people who said that Milton Friedman had it right. The responsibility of every corporation was to increase the return to the shareholders. So more people are speaking out against ESG.
And in the final surprise of 2022, we thought that there would be a setback in the green energy program, specifically relating to lithium, that the U.S. would find a shortage of lithium batteries to power electric vehicles that are planned for production. And we also thought that the U.S. would introduce some programs to boost production. And this is something that came up in the bipartisan infrastructure law that was passed last year. It was a $7.5 billion allocation to electric vehicle charging networks, but there was also a $7 billion program in order to help to jumpstart or provide for the electric vehicle infrastructure, particularly around the U.S. developing the supply chain. I think that's the down payment on what will ultimately be a much larger investment need, but it's a start.
We still have to face up to the reality that China controls most of the rare materials that are needed for electronic vehicles. So we may have enough supply for 2022 and maybe for next year too. But somewhere out there, I think the materials necessary for electric vehicles is going to come into short supply. And we'll have to yield to China to get them to be more cooperative in providing those materials.
That's right. China has 75% of the electric vehicle battery manufacturing capacity. And when you think about the mining, the U.S., to my knowledge at least, only has one mine for lithium, and that's in Nevada. I think that contains about 3.6% of the lithium reserves globally. So the U.S. has a long way to go. Every year, we have a number of surprises that don't make the top 10 for one reason or another. Either we don't have as much conviction in these as we do with the 10 surprises, or they're not as relevant or market sensitive as the other surprises. And in 2022's list of surprises, we had 4. I'll cover these quickly. First, we thought that the FDA would approve the first ex vivo gene editing treatment and stimulate further research into genomic medicine, and there'd be progress in developing gene therapies. This is one that really captivates my interest. I think it was reading Walter Isaacson's Codebreaker that was partly the inspiration of this. I think we could say that we largely got this right.
Well, I don't think we're going to have gene editing anytime soon, but there's no question that technology is going to play a greater role in healthcare.
The next also ran, we thought that the digital economy would get a major boost when Jamie Dimon capitulated, and he reverses his position on cryptocurrencies and sets JP Morgan on a path to become the world leader in the space. If there was ever a bigger swing and a miss in any of our 10 surprises or also rans, I'd be hard-pressed to find it.
Well, Michael Zembeles, the chief investment strategist at JP Morgan, said that the bank embraces the concept of blockchain, but doesn't pick cryptocurrencies.
Well, the next also ran was that the U.S. and China would both seek to become the global leader in advanced semiconductor capabilities in order to reduce their dependence on offshore manufacturing the technology. We had the CHIPS Act, or CHIPS Law, in 2022, which I think is a very good set of incentives or a down payment on the U.S. developing that semiconductor technology. So this one I would score in our favor.
Yeah, everybody's trying to catch up to Taiwan Semiconductor, but they keep doing it better and better.
Well, the last of the also-rans was about Puerto Rico. And again, we always insert something in here that's a little bit more whimsical, just to send a message that we don't take ourselves too seriously. I don't know that we're ever going to see resolution on this one, Byron, but it was at least a nice thought.
Well, in the markets, you never fight the Fed, and probably in terms of retirement communities, you never fight God, and hurricanes really put Puerto Rico as a less likely retirement community.
Well, that wraps up the 10 surprises of 2022 and the also-rans. And now we're going to turn to the 10 surprises of 2023. So Byron, why don't you get us started?
Sure. Multiple candidates on both sides of the aisle organized campaigns to secure their party's nomination. Why? Because the headliner names may choose to back out of the race as well.
I think this is one of those surprises that is going to sort of come into consensus and probably move out of consensus. And I think we're going to see a lot of back and forth on this one. But my guess is we're going to be editing or reviewing this one all the way down to the end. And I think we're going to see a lot of uncertainty here.
Well, right now, both are running. And so we'll have to keep monitoring it. The second surprise is the Federal Reserve continues in its tug of war with inflation. So it puts pivot on the shelf. I don't think they're going to pivot. They're serious about trying to get the Fed funds rate down to 2%. I can easily see it gradually coming down to 4%, and maybe over time down to 2%, because the comparisons will be easier. The important point here is that the federal funds rate will rise above personal consumption expenditures. Right now, that's about 5. I think the federal funds rate will go above that, and so we'll see real interest rates for the first time in a decade.
So I'd just add one thing to this, and that is, we are clearly past peak inflation, and I think disinflation is likely to play out in a couple phases. The first phase we're in right now, which is the easy to solve stuff, right? And that would be things like supply chains opening up. We've seen the cost of shipping fall to basically pre-COVID levels. And I think there's going to be a lot of sort of focus, or people are extrapolating these early and big declines in inflation. But the second phase, in my opinion, of disinflation is going to be a lot costlier, and that's wages. And I think wages will end up being a lot stickier. And even as we do at some point hit peak wage gains and you start to see average hourly earnings growth slow and things like that, I think the big challenge is, how do you get income or wages back down to a level that's consistent with 2% inflation? I think that's going to be a challenge in 2023, which is one of the reasons why I think the Fed puts the word pivot on the shelf. Personally, I'm of the view that the Fed won't be cutting rates in 2023. That's probably one of the more out of consensus views among these 10 surprises.
Well, one of the things is that time is on our side, in the sense that you're going to be comparing with higher numbers on a year-over-year basis. That doesn't mean you won't have sticker shock when you go to buy something, because the price will be high, but the year-over-year price increase may be smaller. The third surprise for this year is that while the Fed is successful in dampening inflation, it overstays its time. One of the things you've got to take into account is the fact that while the Fed is raising rates, it's also quantitatively tightening. That is, allowing its balance sheet to run off. And the combination of those two things make real interest rates on the Fed level over 6%. And so that's creating a real interest rate much higher than the public perceives.
And the idea of overstaying its time in restrictive territory, I think, puts downward pressure on growth. And I don't think it's just a phenomenon here in the United States. I think we see this all around the world. And if 2022 was a year where we were relatively optimistic on the economy, but more defensive on markets, I think we could see almost the opposite in 2023, where I think the economy has a bigger challenge because of how high the Fed has taken rates and how long they keep them there, plus the influence of QT, as you point out.
Well, if that's the case, Joe, one of the things that puzzles me is that the consensus earnings for 2023 is still right up there at 215. So what we're seeing would suggest that that number is too optimistic. For the fifth surprise, we thought that there would be some kind of financial asset because any correction in the market is usually accompanied by one. Cryptocurrencies certainly had a major correction, but I don't think that was embraced broadly enough to be considered the financial asset. And by now, nobody is believing in monetary theory because that hasn't worked with inflation rising. So we don't know what it's going to be. So the function of the fifth surprise is to say, watch out for it. Because if the market continues its correction, there could be an accident out there, which we're not smart enough to anticipate.
Yeah, and I think the data behind this one is in periods of coordinated tightening, you do tend to get these accidents. And we're in an environment of what is the most coordinated tightening in history. About 85% of all central banks were hiking rates last year. And again, to your point, Byron, we want to sensitize our viewers to this because I think as you said, we're not necessarily out there to try to predict what it might be. But what we know from history is in periods of coordinated tightening, you've got the Thai baht crisis, the Russian ruble crisis, long-term capital management, the tech bubble, the housing bubble, and even the 2010-2011 euro debt crisis was a period of coordinated tightening. In the sixth surprise, we think that the Federal Reserve remains more hawkish than other central banks, and as a result, the dollar remains relatively strong against major currencies, including the yen and the euro. I don't necessarily think that the dollar is going to rally much from here, but when we say relatively strong, at least the way I think about it is that the dollar is not going to give up much ground. And that, in my opinion, creates what is a generational opportunity for dollar-based investors to invest in high-quality Japanese and European assets. The currencies have already made major adjustments for the interest rate differentials and the growth differentials. And I think that creates enormous opportunities for dollar-based investors. We wrote here Japan and European assets, high-quality Japanese and European assets in particular, but you could expand that to Australia and Canada and a number of other countries, in my opinion.
Well, one of the things we have to recognize is that in the case of Japan, because of the Taiwan-China conflict, in the case of Europe, because of Ukraine, multiples have come down there. So the opportunities are exposing themselves. And if the dollar remains relatively strong, you can take advantage of it and expand your focus beyond the United States to overseas assets.
The seventh surprise, we think that China will end up moving toward its growth objective of 5.5%. And in a lot of respects, this is simply about its rebound from its zero COVID tolerance policies. There's enormous amount of, call it a fiscal impulse or an economic impulse in China as they have moved toward reopening. We have not yet seen it, but I think 2023 will be a year of strong economic growth there. And the second part of the surprise is that we thought that the U.S. would start to, the U.S. and China would move aggressively to reestablish a strong trade relationship. And that, as we write, has positive implications for real assets and commodities.
Yeah, there's no sign of that yet, but we think trade is an important reason for that to take place. And by no means do we think China is going to get to 5.5% in 2023. We just think they'll be up from 2 to 3%, which is where they are now.
Right. It's about year-over-year comps. They're coming
Yeah.
off a very low base. And in the eighth surprise, we're revisiting oil. And we think that the U.S. will become not only the largest producer of oil, but also the world's friendliest supplier. As we do think there is a possibility of a global recession, it means we will see volatility in oil prices. So one of the things we wrote here is that WTI could touch 50 this year, but it's our view, the view of Byron and me, that there's a $100 tick out there somewhere beyond 2023 as the world recovers.
We try not to have the same surprise 2 years in a row, and that's why gold isn't in the 2023. We made an exception for oil because it's the most universally used commodity. The one thing that this one suggests is that we're going to be using fossil fuels for a long time in the future. I don't think any of the current targets for electronic vehicles are going to be hit. I think it's going to take some time for us to really go green.
In ninth surprise, we think that there is the potential for a ceasefire and negotiations from the war in Ukraine in 2023. Now, maybe that comes in the second half of the year, but we are more optimistic that we could see peace in Ukraine.
I think the casualties on both sides are pushing both countries toward some kind of ceasefire. But the negotiation on a territorial split will go on indefinitely because neither side wants to give up anything. So I think we could have a ceasefire without a territorial agreement. But, I think the war looks intense right now, and so this one seems less likely. That's why it's a surprise.
And it would be a positive surprise in that if something breaks, it breaks to the positive here in Ukraine.
Yeah, people worry that we're too negative on this, but we see a positive in the market in the second half, and we see a ceasefire here. And those are two important positives.
Well, switching gears to the 10th surprise, Twitter. This is one where we're going to be tested on this pretty early this year. But it's my view that Elon Musk can get Twitter back on the path to recovery. I think we're really going to get tested on this one, Byron.
What do you mean, going to be? We're tested every day. It looks bleaker and bleaker for Twitter because of what he's doing. He's not paying rent. He's fired a lot of people. They're not providing the services. The issue of what is and isn't allowed on Twitter is still confusing. This one doesn't look good, Joe, but we never get them all right.
I'll take responsibility for it. Well, every year we do have a number of also-rans, and this year is no exception. So we do have three. The first is that we think there will be a medical breakthrough on cryogenic burials. And I think, Byron, you were the one that penned this one. You thought, at least you came up with the marketing slogan before the technology, and that it's nice to be on ice.
Yeah. Well, we always have a whimsical surprise in the 13, and we put it in the also-rans this time. So don't take this too seriously. But life expectancy is going to be extended for a longer period, and it may even go post-mortem.
You heard it here first. The 12th surprise, or the next also-ran, is that we will see a technology breakthrough reducing the carbon emissions of coal-fired plants. And we think that will take the edge off the climate and global warming scare. It also will lower the political pressure on emerging markets to make this rapid transition to renewables.
Yeah, the idea here is that there is a technology out there that can reduce carbon emissions. and it can be embraced economically. It hasn't really been seen yet, but we think it's under development and will emerge in 2023.
Now, the last of the also-rans is dealing with India, and we think that they can begin to compete seriously to win and retain manufacturing base that started looking for a new home after becoming increasingly uneasy with the uncertainty that has continually surrounded the US and China policies. I think what's going to be interesting to watch here is Apple and Samsung. And it's my view that they are proof of concept after successfully moving it and producing their respective flagship phones in India. Now, Apple has shifted production of the iPhone 14, and I think that sends a really strong signal as to what India's capabilities are in manufacturing. Now, this one might be a long shot. India has been sort of the great manufacturing hope for decades, but with the volatility in US-China policies, as well as the volatility around COVID policies, I think there is a chance that India can capture at least some of that global manufacturing base.
Well, what we always have is the zeal of companies to de-emphasize China, to move away to Vietnam, Cambodia, Indonesia, and so forth. So this is really in that vein. And we're also trying to onshore manufacturing more back to the United States. So India is the obvious pick, but it isn't without its geopolitical uncertainties. And so this one isn't a sure thing. That's what makes it a surprise. But we think not sufficient attention is being paid to the potential of India as a manufacturing base. The wage differential between India and the US is just too great, and that's what makes it attractive.
Yep, they have proof of concept in medical devices, in branded and generic pharma, and there's a robust electric vehicle supply chain that's being built in India. And now with Apple and Samsung, I think you see the technological component there. So that brings us to a close on our 10 Surprises of 2023 webinar. As always, thank you for tuning in, and we look forward to speaking with you next quarter. Thank you.